All right, let me tell you about a private chef I worked with named Alex, a 45-year-old independent high-end client. Been doing this a long time. Private dinners, weekly clients, events, solid reputation, stays booked most of the year. 1 month, right in the middle of a busy stretch, two things happened almost back to back. A big client canceled with short notice, and a few days later, he had to replace equipment he relies on daily. Nothing optional, both had to be handled. Alex had money coming in, but like most private chefs, it wasn't sitting neatly in one place. Some of it was tied up to upcoming gigs, some of it was already allocated for ingredients, assistance, and travel. Some of it was sitting in accounts he didn't want to touch because of taxes and penalties. So, once again, he was doing what he always does, moving money around, delaying things, trying to make timing work. A little later, he was talking with another private chef he knows, just catching up, talking about cancellations, equipment costs, and how unpredictable this business can be, even when you're doing well. Alex mentioned how frustrating it was that every time something expensive popped up, it turned into a scramble. That's when the other chef said he used to deal with the same thing. And that's why he started keeping a portion of his money inside a life insurance policy that he could access when things like this came up. Alex stopped him and was like, "What do you mean?" Because he had never thought of life insurance that way. To him, life insurance was just something you had in case something happened to you, not something you actually used while you were alive. So he started asking questions, and what he learned was simple. The money could sit inside a permanent policy designed to grow tax free, stay protected, and still be accessible whenever he needed it. That's when it clicked. His income was strong but unpredictable, and everything depended on him staying healthy, available, and working. So he reached out to me and told me exactly what he wanted, and that's what we built. Alright, so let me show you what this actually looks like. What you're looking at here is a plan we set up for Alex. We designed this as a 5-year funding plan. Alex didn't want anything aggressive. He chose to put in $25,000 a year. That was the amount he was comfortable setting aside annually for stability, flexibility, and long-term security. So, from age 45 to 50, he's funding it at $25,000 a year. Over 5 years, that's a total of $125,000. Now, when you look at an illustration like this, there's only a few things you really need to focus on. First is the cash value. Cash value. This is the money inside the policy that's actually earning interest. When he puts money in, there's a cost early on, and the rest of that money flows into cash value bucket where it grows over time. The next column is the cash surrender value. This is how much money Alex can actually access. Think of this as his available balance. This is the money he can use if a client cancels unexpectedly, equipment need to be replaced, travel or staffing costs spike, income slows down for a stretch, there's no penalties, there's no age restrictions, there's no taxes when he accesses it. That mattered to him because, unlike retirement accounts, this money isn't locked up. You also see a projected rate This isn't a guarantee, it's just a projection based on how the policy is designed and historical performance. We're not assuming anything crazy here, just steady growth over time without market risk. So when you zoom out, look at this after 5 years. Here's the simple picture. Alex put in $125,000 and now he has a pool of money that is growing, is accessible, and isn't dependent on his next booking. Instead of everything being tied to his calendar, clients, or timing, he now has a place where money can sit, grow, and be there when he needs it. Now, here's the part that really mattered to him. After age 50, he stops putting money into this. Nothing else goes in. He just lets it do what it's designed to do. When we fast forward to age 65, there's a meaningful amount of money sitting there. Not just as a number on the page, but as freedom. He liked knowing that if he wanted to take fewer events, travel more, or be selective with clients, he had something to lean on. That's when we looked at age 70. Same story. The money is still there, it's still growing, and he still has access to it. For the first time, the future didn't feel like it depended entirely on how long he could keep working. It wasn't about quitting what he loves, it was about having options, and that's what this plan gave him. Now, if you're watching this and you want to see what something like this could look like for you based on how you actually make money and how your income flows, I'm happy to walk through it with you. You can schedule a call using the link below, or just send me a message and we'll go from there. Thank you. See you soon.